It may be reasonable to assume that a business that is growing is by definition a successful business, but is this really the case? Business success can be defined in a number of ways: by increased orders, higher turnover, more employees, and most obviously greater profits. A business may have begun with just one or two company vans. But as it has grown, so has its fleet. This may mean that its fleet consists of a number of vehicles, each with its own insurance policy and renewal date, and over time with the older vans needing more costly maintenance or repairs. Then there are the associated costs of administration, both in time and money, of keeping track of all these different arrangements. Plainly, there will come a point where a single company van insurance policy with one renewal date for all vehicles could be easier to administer. There are likely to also be cost savings from bulk leasing, or buying, through one supplier, as well as for fleet insurance, which should be rewarded with a discount on the premium. A fleet van insurance policy would mean all the company's drivers being insured to drive any of the vans, which would improve flexibility and productivity, as no driver would then have to wait for a particular van to come back before they could go out on a job. The cheapest fleet cover would be third-party, fire and theft, which only covers any liabilities you might incur to others. However, it does not cover any injury to the driver or damage to the vehicle, which could prove more costly in the long run. Land Rover is a brand renowned for its strength and durability on all types of off-road terrain, and the company estimates that around two-thirds of the cars it built in 1948 are still in use. Since the company built its first vehicle in 1948, however, its range is diversified to include on-road versions as well as more economical models. This means that different models are now likely to be classified in different Land Rover insurance groups, depending on value and power. Generally, the higher the group number, the more expensive the insurance premium will be, although the cost of road tax is also one of the features that can affect the premiums. The lowest cost is likely to be the Freelander, usually classified in groups 21 to 25. This is because it is a medium-sized SUV with a smaller engine than some models. The Discovery range of Land Rovers finds different models in different insurance groups. The Discovery models are generally at the top end of the range. The standard model is in Group 33, while at the other end of the scale the HSE luxury models are in Group 42. Range Rovers were launched in 1970 and models can be found anywhere from Group 35 to Group 50 depending on the model. Does being a woman make any difference to the cost of Land Rover insurance? Well, since March 2011, when the European Court of Justice ruled that it was illegal to take gender into account, car insurance costs for women can no longer be determined on the basis of gender. That is despite the fact that on balance women are generally involved in fewer accidents than men, and if they do have an accident, claims are generally for minor bumps rather than complete write-offs, and so tend to be less expensive than those made by male drivers. However, age is still a factor in insurance costs, and the more mature the driver, the less expensive the premium is likely to be. Under 25s tend to pay the highest price. Premium costs also take into account the type of car being insured, so the smaller the engine the less expensive. They also consider the cost of replacement parts and repairs as well as the likely mileage per year. So while women can no longer get lower cost car insurance for their gender, if they tend to drive a smaller car for fewer miles per year, and they are mature drivers, their insurance premiums are likely to be lower. Share this video and subscribe for more interesting auto insurance tips.